Which is the best dividend stock to buy? I'm going to answer that question looking at four different stocks, including Deere, Pepsico, Target, and Procter Gamble. I'm going to compare these four dividend stocks across five different metrics. So let's get started with the details right now. All right, starting with dividend yield, you look at these and you have three companies with a very similar dividend yield of near 2.6%, and that includes Pepsi, Target, and Procter and Gamble. They're all right around 2.6% dividend yield. And then you have Deere at the very bottom offering a dividend yield of 0.86%. But remember now, when you're investing in dividend stocks, your total return includes two sources. One of those sources is the dividend yield. The other source is the capital gain return. In other words, the change in the stock price. So you're not going to get your total return just from the dividend yield. You have two components. So the dividend yield is just one of the two components to look at. And sometimes, in most cases, the capital gain yield will be greater than the dividend yield, especially when you're dealing with stocks that have dividend yields of below 4%, like these four stocks have here today. The next metric I wanted to compare these four dividend stocks on is revenue growth. And what I have here is annual year-over-year revenue growth going back to 2013. So looking at this metric, what we notice is Deere is the most volatile of these stocks, and that's understandable. It sells expensive farm equipment and some construction machines, which are replaced every several years or so. So you don't have this steady purchasing of every year. You have lumped up purchasing that happens. Let's say a group of companies buys and upgrades their equipment in a certain year. They're not going to need to upgrade that equipment for a long period of time, 5, 10 years maybe. So when that time comes up again, that 5 year period comes up, you get another big boost of revenue in that time, and then it goes on without revenue growth for a while, and then you get that boost up again. So that's why you have these fluctuations. But the interesting thing about Deere right now, it's got a huge backlog of orders. It's got a lot of customers that want its equipment that are waiting in line to get it because of supply chain shortages. Deere hasn't been able to fulfill all the customer demand, and still revenue growth has been above 15% for 2 straight years. And I part of that is due to price increases the company has implemented, and part of that is due to the tech upgrades Deere is infusing its products, its next generation products. So Deere's got excellent prospects over the next at least year or two. And then we get PepsiCo, revenue growth of 8.7%. PepsiCo is one of the prime beneficiaries of the coronavirus pandemic. If you're not aware, PepsiCo has a snack segment that's just as large, if not larger, than its beverage segment over the last couple of years, especially the snack segment, including Frito-Lay chips, has done much better than its beverage segment because people have been spending more time at home. We're closer to our kitchen and we're closer to our cupboards and pantry, and so we walk over there, grab a snack more often than not, and that's been really good for PepsiCo. Meanwhile, Target also benefited from the pandemic because it was deemed an essential retailer and allowed to stay open while many other businesses, brick and mortar, were forced to close. And so folks had more money to spend, fewer places to spend it. Target benefited from that trend, as did Procter and Gamble for similar reasons. People have more money to spend, fewer places to spend it. Procter and Gamble generally sells premium products, right? Premium products in the home health care, shaving categories, things that you use repeatedly, and they're in the premium category of those products, right? They're not in the lower price category. So if you've got more money, less places to spend it, then you tend to go for the more premium products when you go shopping at a store like Target. However, that's going to be a headwind for Procter and Gamble over the next several quarters now. inflation is pinching consumer budgets, and they're now looking to get more bang for their buck, and they're trading down from these premium products to more store brand generic products, and that's been a headwind for Procter & Gamble over the next several quarters, and I suspect it will continue as a headwind over the next several quarters as well. The next metric I wanted to compare these companies on, these dividend stocks on, is the operating profit margin over the trailing 12 months. And according to this metric, Procter & Gamble has been in the lead for a long time. Like I mentioned, they sell their products in the premium price category, so that allows for higher profit margins, and that's evidenced here by their operating margin that's above everyone else's. However, as Deere has been improving its sales over the last several years, it's catching up, making great progress in terms of operating profit margin expansion, reaching 21% in its most recent trailing 12 months. That's likely to persist over the next several quarters, maybe even over the next several years, as it has increased prices, as customers are being forced to pay those higher prices because there's such a backlog, there's little room for negotiation between its customers and Deere, and so those premium price realization is likely to persist for a little while longer at least. Pepsico, double-digit operating profit margins, 12.87%. This has been coming down mostly due to the forces of inflation, increasing the cost of goods sold, increasing the price of transportation, increasing the price of wages, making it more difficult for Pepsi to operate at higher margins. And then finally, we have Target in last place here with the operating profit margin of just 3.53% in its most recent trailing 12 months. This is largely due to the fact that Target overinvested in inventory because it was plagued with several quarters where it didn't have enough inventory. So it got tired of seeing its shelves empty and customers come in and find that they don't have the products that customers were looking for. So they just went out and over invested in inventory. Now they've got way too much inventory, and over the last 2 or 3 quarters, they've been offering big promotions, big discounts to get rid of that inventory. And as they've been doing that, it's been decreasing their profit margins, and so it's been cut by more than half from the over 8% in 2022. Now it's come down to 3.53%. This will persist for the next, I would say, at least 2 more quarters, and then it remains to be seen where it goes from there. It depends on how much progress Target makes in getting rid of the excess inventory and how long it will take for them to get through that excess inventory. This is something to watch closely. Over the longer term, in let's say 2 years' time, you can expect Target's operating profit margins to rebound closer to the 6% level, not as high as the 8% it achieved during the pandemic. That was a little bit above its usual trend, and this 4% is way below its usual trend, as you could see. 6% is something you can reasonably expect going forward. The next metric I wanted to look at is the cash flow from operations to sales. I want to see how good the company is at turning sales into cash flow from operations. And in this metric, again, Procter & Gamble takes the lead here at 18.19%, although that has been coming down significantly in recent quarters. Meanwhile, Deere had been coming down, but it's recovering up to 10.93%. Pepsico also trending downward at 12.51%. And then finally, Target also trending downward at 3.68%. So you notice all of these companies trending downward in terms of cash flow from operations to sales in the trailing 12 months, except for Deere, which is rebounding higher now over the last couple of quarters. The rest are trending downward, and that's understandable because these were all primary companies that benefited from the pandemic. The forces of the pandemic, in one way or another, benefited each of these 4 dividend stocks. So now that economies are reopening and that momentum is increasing, it's understandable that they would come down off of those peak performance levels they achieved during the earlier stages of the pandemic. All right, finally, I wanted to look at valuation, and I chose to use the forward price to earnings ratio. Looking at this metric, Procter & Gamble and Pepsico are the most expensive, trading at a forward PE of 24.4. Then you have Target trading at a forward PE of 18.9. And finally, you have Deere trading at a forward PE of 13.36. So if I had to pick one of these four dividend stocks to buy right now, looking at all the metrics we look at and everything else I know about these four stocks, I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. I would be picking Deere. Deere would be the dividend stock I would buy right now. And as a bonus, what Deere stock gives you, the investor, is a certain degree of inflation protection and inflation insurance and inflation hedge, because Deere's equipment is more highly in demand when commodity prices are higher, right? When prices of apples and corn and soybeans and all of those commodities, when those prices are higher, the demand for Deere's products increases. And so if the prices of those commodities are increasing, that means inflation is increasing. And if you have Deere stock would likely be going up as the price of these commodities are increasing. So you get a certain, not complete, not total inflation protection, but you get a certain degree of inflation protection with Deere stock, which is just an added bonus, right? The company's already doing a really good job right now. Its profit margins are expanding, sales are growing, it's got a strong backlog of orders, customers waiting to buy their products even after they raised prices by double digits, and it's trading at a very reasonable valuation. I would say an inexpensive valuation at a forward price to earnings of 13.36. So for all those reasons, I would choose Deere as the top dividend stock to buy among these four. All right, so that's all I've got for this video. I've hand selected a few other videos that I think you might enjoy that are popping up on your screen right now. So please click on one of those and I'll see you over there. Thank you for watching.